When it comes to luxury stocks, our guest says the sector continues to experience recessionary pressures and the trend is likely to go on. For more, let's bring in Oliver Chen, Managing Director at TD Cowen. Hi, Oliver. Thanks for being with us today.
Hey, Mark. It's a pleasure to be here.
All right. So you see some recessionary pressures. Can you give us sort of a global snapshot as to the demand right now for luxury?
Yeah, what we're really seeing is outsized growth in the Americas, a lot of caution in Asia Pacific. We continue to monitor the tariff situation in China and also housing overhang. So consumer confidence has been a lot more bumpy in China. On the Americas, on the other hand, the S&P 500 performance of over 20% last year, the resolution of the election, those have been positive drivers for consumer confidence. So a bifurcated situation, more caution in Asia, and more enthusiasm for the Americas. The same is true as we think about stocks. The big call we made this week was upgrading Richemont on Monday. What we're thinking about Richemont is that we're in a nice jewelry cycle, a nice non-bridal jewelry cycle. And as you know, their flagship brands are Cartier and Van Cleef. That is a segment that's really working well and working better than fashion and luxury goods, which LVMH is most exposed to. We're recommending both Richemont and LVMH, but we acknowledge that jewelry is going to grow faster than handbags for the foreseeable future.
All right, we'll get back to LVMH, and we know that Richemont had a big jump on its shares earlier in the week based on its numbers. But now, in terms of strategy, you're recommending if investors want to get into some of these luxury stocks to have a combo pack strategy, and you want to focus on certain themes. So can you elaborate on that?
Yeah, what's really important in this whole idea in luxury of timelessness, and the Cartier Richemont platform has these brands such as Cartier and Van Cleef and platforms like the Love and Santos more specifically that have done a great job with timelessness and offering value to the consumer. We're also seeing this major trend mark of quiet luxury, which is a little more discreet. And Cartier is executing very well in quiet luxury. But as we think about combinations, what we actually want to see in luxury going forward is louder luxury, better fashion, and we're optimistic that that will happen in the back half with a lot of new changes at designers such as Dior, Givenchy, Valentino, and others. That should help the industry as a whole. Consumers are yearning for more excitement, but we're also looking for value and being a little bit boring and choiceful. So this combination is a strategy that we hope will happen in 2025. As we zoom out in the combination thesis, we also love names like Walmart, which is at the other side of the barbell, which offer consumers both exceptional value, being a number one grocer, plus exceptional technology, curbside pickup, digital marketing, digital advertising, as well as AI. So this whole combination strategy manifests in a few ways in retail. Think about value plus technology, think about quiet luxury plus loud luxury.
Now, I understand that BJ's Wholesale is your top pick, and most people probably wouldn't associate luxury with BJ's, but can you explain this? Because are they kind of similar to Costco in that regard? They have high-income people coming into their stores?
Yeah, RTD surveys indicate a consumer that's also wealthy and very similar to the Costco demographic. So what you're seeing really is wealthy customers love this channel, whether it be Sam's, Costco, or BJ's. The big deal at BJ's is that you get a much better price because the PE ratio is about 25 times, whereas Costco's in the high 40s. So the price to earnings multiple is quite a good value at BJ's. At the same time, they have a modest store footprint at 250 stores. Sam's and Costco are at 600 plus. So a lot of nice growth in BJ's ahead and opportunities to improve their general merchandise as well as fresh assortment and very good consumer renewal rates. So those are all things working in BJ's favor in terms of our call for the year. Last year, our call was Walmart. Keep in mind, we still like Walmart, we still like BJ's, we still like Costco. And on the other side of the spectrum, we like Richemont and LVMH.
Right. A nice segue to LVMH. I see that it's the best performing stock on the CAC 40 in Paris so far this year, up by 8.5%. Hermes is up 7.6%. So is that just investors buying the losers from last year, or is there some meaningful growth behind this?
Yeah, LVMH is a powerhouse. It's market leading $9 billion of marketing spend. And their brands, the flagship brand Louis Vuitton, as well as Dior, and you also get Sephora in that business and champagne businesses. So nice diversification. And investors are looking for value. Fashion and leather goods is an area they continue to innovate in. I would say we're going to see jewelry grow faster than fashion and leather. Fashion and leather will probably grow in the 3 to 5% range longer term, whereas jewelry will grow higher. And we're also still modeling negative numbers for fourth quarter at LVMH, but it's a juggernaut of a company in terms of the scale, the leverage, and the long-term thesis at LVMH remains the same. That's why we like it, in part because these power brands really make meaningful innovation and drive consumers on the basis of big footprints of marketing spend as well.
All right, Oliver, very interesting, fascinating. I prefer my luxury, if I have any whatsoever, to be quiet, not loud, but really interesting. Thanks a lot, Oliver.